Sanjeev Prasad joins us. Let's take our conversation forward. Let's understand that what is, bets for 2022 are. Sanjeev, good morning. Fantastic to have you back. Sanjeev, let me start with a very basic question. 2021 was a grand year. For 2022, what should we expect? No returns, low returns, negative returns?
I think low returns may not be a bad outcome, given the facts of number one, the starting point on inflation, on valuations are clearly on the higher side, right? A lot of stocks have correlated and sectors have correlated significantly in the last 12, 15 months. So from here to expect further re-rating looks challenging, especially in the context of the second fact, which is interest rates will move up. You're already seeing bond yields, having gone up quite significantly from below 6% to now reaching almost 6.6%. I'm talking about 10-year GSEKs. Global bond yields have also started to move up. More central banks keep on tightening as we go along. So that will also act as a headwind to equities, especially multiples. So despite all the good news about revival in the economy, strong earning growth, and so on and so forth, a lot of that could be offset because of some de-rating and multiples as we go along. So I think the best thing at this point in time would be to keep modest return expectation for the year, and you can see how it plays out. If it turns out to be a better year than what we are assuming as of now, well and good. The other points you have to keep in mind is also that the world is becoming more and more unstable, unfortunately, given all the geopolitical potential accident which could happen. And I hope nothing goes wrong, which results in a big correction in the market, whether it is something going wrong on the Russia-Ukraine issue or in Taiwan Strait, who knows, but these are potential flashpoints. Not that we can do much with respect to the portfolio when it comes to such issues, but these are overhangs or risks which are clearly not there in the price, I would say, currently.
Do you see a situation where US markets, global markets, they underperform and we outperform? That's been the hallmark for 2021 as well. Given how US tech stocks have melted, how China is underperforming, is there a case for India to do better both in absolute and also in relative terms?
Looks difficult, I would say. See, last year, India did similar to the US. Both the markets did actually very well in the global context. Obviously, China struggled in a big way. If I remember my numbers correctly, I think India was up about 22-24% in dollar terms. S&P was a similar number. Nasdaq was slightly higher, and China was down about 7-8% in dollar terms. Coming into 22, the starting point for both India and US is pretty same. You have expensive valuations plus rate increases as we go along, and some of that is already getting seen in the bond market at least. I think the policymakers will be behind when it comes to interest rate increases, but bond markets already pricing some of the rate increases. They've already done partly, I would say. And both, if you look at the US 10-year, India 10-year, we both have gone up pretty sharply. So both will act as headwinds to the market. On China, it's a tricky situation. When I talk to investors, many of them point to the fact that valuation is looking a lot more attractive over there. A lot of negative news is priced in, and you could expect a rebound. And people have positioned for that over the last 1-2 months. If you see in India, there have been large FPI outflows, especially in the secondary market. FPI has been selling aggressively, and they've been putting that money in China on expectation of some recovery in the market. But obviously, China has its own dynamics. It's not an easy market, especially given the confluence of economics and politics over there. So how it exactly plays out, we'll have to wait and see. But not knowing much about China, just looking at valuations, I would assume that maybe China does better this year, and that's based more on the conversation which I'm having with clients.
Okay, so that's of course the global setup that has come into play. But Sanjeev Prasad, if I could get more specific about India, yesterday of course we saw 18,000 back on the screen as far as the Nifty 50 goes, and this time round it's also thanks to the banks that have led to this. Would love to get your views on where the financials are headed and your top picks.
Sure. If you look at sector-wise breakdown for India, from a valuation perspective, it's only the banks which are looking somewhat reasonably valued. You compare, valuations on, let's say, from pre-COVID levels, on a 1 year or 2 year forward, everything else has got significantly related. Particularly, if you look at the IT names, many of them used to trade at about 15 to 20 times 2 year forward from pre-COVID levels. Now everything has now become more like 25 to 45 times 2 year forward. So clearly things are pretty pricey over there. Same thing I'm seeing in many of the consumer discretionary stocks. You have seen a big rating, whether it is the paint companies, durable companies, retailing companies, again seen a big rating in multiples over there. The only sectors which haven't seen much of re-rating are banks. In fact, many of the banks are at lower multiples compared to pre-COVID levels, and especially some of the the smaller NBFCs, they are actually looking reasonably attractively valued, at least on valuations. I mean, you can question the business model, some of them, but compared to pre-COVID levels, they are actually trading at far lower levels now. So financials look interesting, I would assume, especially given the fact that you have some tailwinds of lower loan loss provisions going forward, and some recovery in income and pre-provision operating profits. So that combination of lower loan loss provision, higher PPOP, pre-provision operating profit, should result in a significant uptick in PBT, PAT, ROA, and ROE. So that should result in some rating on the multiples for banks and NBFCs in general, I would assume. Beyond that, we have been positive on things like real estate and capital goods on expectation of multi-investment cycle on both housing and private capex side. Stocks on up, multiples are being expensive, but I'm reasonably still positive on multi-investment cycles. So I'm not really cutting the recommended positions over there, and on expectations of hopefully a decade long period of growth. I'm sort of still leaving them in the portfolio, despite the fact that valuations are still looking somewhat expensive on immediate earning numbers over there. Other than that, consumers, pharma starting to look slightly more interesting. Autos also looking interesting, and especially in case of autos, you could see some uplift coming from not just volume recovery, which will happen anyway, given the fact that last year was disrupted significantly because of supply side issues. So you will see some normalization on semiconductor supply side, and which will result in volumes picking up. But more importantly, 22, when I say 22, that's fiscal 22 numbers were badly impacted by gross margin compression. We had a big increase in RM prices, and as companies pass on prices to some extent, plus you see some decline in RM prices, you could see gross margins coming back pretty sharply. And I think the same thing would play out in consumer staples also. There also you've seen a reasonably sharp compression in gross margins in the current financial year or in 21, whichever way you want to look at it. And clearly those companies have pricing power. Multiples haven't gone anywhere. Many of the stocks have got derated over the last 12, 15 months, they have been sort of stuck sideways. So I think you could see some absolute returns in these names just based on on roll forward of earnings, and hopefully not much of compression in multiples. Whereas some of the other sectors which I talked about, namely consumer durables, paints, and IT, the risk we're running is multiples are very high, and the strong earning numbers could be partly offset by some derating multiples as we go along during the course of the year.
Okay, so that's the sectoral update that is coming in across the board from Sanjeev Prasad. But Sanjeev, today we're talking on a day where the metals are losing their luster in trade. They are selling off. We've seen one global brokerage firm, for example, talk about cutting their EPS 18 to 23% for FY23 for the likes of Tata Steel as well as JSW Steel. What's your stance when it comes to the metal pack?
It's a tricky one, to be honest with you. In our own model portfolio, we only have Hindalco now, because Hindalco is more of a downstream company. The share of upstream business in terms of overall EBITDA or PAT is actually much lower than the downstream business. Our expectation downstream businesses should continue to do well. Anyway, it's a play on global economic recovery and especially reopening, because both automobiles and beverage cans require a lot of aluminum. Hindalco has very strong positions in both the segments, and you will see a reasonably strong recovery in volumes in both the segments over calendar 22. So I'm quite okay with leaving Hindalco in the portfolio. Beyond that, on metal prices, the big call is really China. Unlike oil, China is a big consumer of metals, right? If you look at steel, if I remember my numbers correctly, about 45% of total global steel consumption is in China. Aluminum is like something like 60%, and other metals, same 40 to 60%, consumption in China. And if China is slowing down significantly, clearly it will have ramifications for global commodity prices, and especially for metals, given China's overbearing influence over there. Now, in particular, you have to keep an eye on real estate over there, and real estate is a large part of the economy, depending on whose numbers you want to believe. It's between 15 to 30% of GDP. And if you look at steel, about 35% of all steel in China goes to real estate, by the way. And you have seen very significant correction in residential real estate volumes in China. So clearly you would have some sort of an overhang when it comes to steel supply. Also keep in mind the fact that steel prices particularly have been supported by some amount of clampdown on excess production by Chinese producers. How long that continues, we'll have to wait and see. So you are now getting a situation where the dynamics are clearly shifting towards more the negative side. And if China's slowdown is for real, then clearly you have, more negative news only out there. And one of the things which worries me about China is, since they have a very hardline COVID, zero approach, and Omicron being a very transmissible variant, the moment you will have a few cases in a city, you will see, very strict, lockdowns. And you've already seen two cities, Xi'an and Tianjin, being put into pretty much full lockdown. And God forbid, if you have similar cases in other cities, you would have similar response, right? And God forbid, if you continue saying this, then you have serious, slowdown in China in that case, apart from, your global supply disruptions and whatnot. So, so metals, I'm not terribly excited, I would say, at this point in time.
Yeah. Some of those visuals coming in from some of those Chinese cities are quite horrific. But the one space, Sanjeev, that I wanted to discuss was telecom. I mean, while it's always been a given that Reliance as well as Bharti are the strongest players out there, but wanted to understand how you're reading into this latest development by Vodafone Idea and the interest payment plan. Now that the government is going to hold that 35.8% stake, clearly somewhere tells you that the promoters weren't all that confident of generating similar kind of, cash flows, say 4 years down the line.
Vodafone Idea, unfortunately, is a price taker in this business, right? And it requires much higher outputs, to be a going concern. And it has got some leeway for the next 4 years, given the postponement of, all the liabilities which it has to pay back to the government at some point in time. At this point in time, with the current level of outputs, it's really a struggle for Vodafone Idea, to continue, servicing the amount of debt it is sitting on and meet the government obligations later on. And it can I won't say chug along, it can, sort of get along, with the current level of outputs. But I assume, when the spectrum liabilities come up, clearly there is no cash flows, to pay that kind of liability, right? So either ARPUs go up significantly, which results in, Vodafone Idea's, cash flow being sufficiently large enough, whenever those obligations come due. Now, I don't know, whether you want to take a call, so much in advance, who knows, what's going to really play out. But at least we have seen some tariff increases. We have seen 2 rounds, December 20 and now in November, December of 21 also. So at least from a Reliance and Bharti perspective, their position is looking more and more stronger, I would assume. And if any of them wants to raise prices over the next few months, I assume that will get quite easily absorbed by the market, I would assume, because anyway, if you look at even current ARPUs for FY23 for Bharti, we have about 200 rupees. This is not very different from what used to be the ARPU in FY 2016. I think it was about 190 rupees or so. So after 7 years, you're coming back to pretty much the same level of ARPU. So at least Bharti has been very vocal about the fact that ARPUs have to be a lot higher, for the sector as a whole, and Bharti, to make much more sustainable returns. So let's see, how this plays along. But clearly, the situation is not great for Vodafone Idea.
Interesting. Sanjeev, we've talked about as to how there is a bit of a juggle between metals and banks on one hand. Banks have begun participation. But purely in terms of a market cap behavioral pattern, would you say that given that one has already lowered our expectations in terms of how the returns are going to pan out in 2022, and it's not going to be the anomaly that 2020 and 2021 turned out to be, would you say one is safer within large caps, or would it continue to be a stock-specific story?
Yeah, I think it's always better to focus on bottom-up, and focus on individual stocks. Even if you look at last year, for example, when banks underperformed and IT outperformed significantly, metal, real estate all did well. Even within sectors, you had a lot of diverse movements. For example, if you look at financials, you had ICICI and SBI actually doing remarkably well. Actually, they were big outperformers compared to overall market. Whereas the likes of HDFC Bank, Axis Index, struggled. So ultimately, you have to look at each company on a bottom-up basis and see what is priced and what is not. If there's value, well and good. If you get some thematic tailwind, apart from the fact that valuation looking attractive, then it definitely helps. Yeah, so at this point in time, at least looking at the broad-based top-down view about banks in general, looks like they could benefit from, as I was saying earlier, lower loan loss provisions, plus some credit recovery, and hopefully this whole issue of the concern which a set of investors had about fintechs having a long-lasting impact on even the lending portfolio of banks. If some of that narrative starts fading away, then we could see some more de-rating in all the banks, I would assume, and valuations are quite attractive over there.
Sanjeev, what's the outsized theme now for 2022 and let's say beyond 2022? And just for reference of our viewers, I'm trying to essentially understand from you, just like EV has been a theme and across the board, whether it's EV car manufacturer like Tata Motors or a battery manufacturer or a EV auto ancillary supplier, that entire chain has got re-rated. Which is the next wave of new profit pool or theme you think, which is small right now but has potential to become big and large?
I think you already mentioned it. New energy, green energy, call it whatever. I think is the big theme for India going forward, because India obviously will consume a lot more energy as we go along. And we have some numbers that we can share with you. As of now, we consume about 30 to 33 exajoules. Exa is 10 to the power of 18, by the way. And that number will go to somewhere about 80 exajoules by FY52 in 30 years' time. I've done some math on this. But if we continue the same way, rely more and more on coal and on petroleum products and gas, I don't think we have much of a future in that case, because A, our imports will increase dramatically, and B, the damage to the environment will be significant. So clearly, India has to move from a very carbon heavy energy portfolio to a much better mix. And I think the dream situation for India is we have a lot of sunshine, so that's great. And if you look at solar tariffs, already fairly competitive versus coal tariffs now. So over a period of time, as technology evolves, you have storage capabilities also. The dream scenario for India is, you move from imported energy for meeting a lot of your domestic energy requirements, or from coal, which is clearly, not a great energy form from a climate change perspective. You move to, solar electricity, which in turn will, power all your transportation requirements through EVs. And, you produce your own solar PV modules and batteries for, transportation. If you can get all these pieces right, I think you have a massive, sector in the making. And I can share some numbers with you. We did some, maths for what kind of battery market size you're looking at in India. And if you assume by FY 2052, you will have 100%, of two-wheelers that is EVs. Four-wheelers also will be 100% EVs by then. And in case of CVs, I think that's some 60% or number or so. You're looking at a $500 billion market, by the way, $500 billion annual market for batteries every year. That's what we're talking about. So it's a mega market that we're looking at. Now the question is, who will build those batteries? I hope it's some combination of overseas companies, domestic companies who will, set up battery manufacturing plants in India. Solar PV modules, I'm not that worried, because anyway, the economics for producing solar PV modules under the PLI scheme plus the import duties is actually very attractive now. And you have a lot of large companies who already announced intentions under the PLI scheme, to put up solar PV module manufacturing. Already have a bunch of players now. So that will anyway happen. So I'm not too worried about solar PV module manufacturing. And that again again as per numbers, by early 2030s, we're looking at a $10 billion solar PV module manufacturing market. But the real big one is clearly batteries. Other than that, you also have so many other sectors here. You've looked at healthcare, healthcare and retailing separately. Both of them are dominated by unorganized sector as of now. And over time, as income levels increase, healthcare services penetration will also increase in India, because most people cannot even afford basic healthcare service in India. And same with retailing will go from unorganized retailing, which is still 80% of total retailing in India, to whatever the number is over time. So both the sectors you will again see mega market cap creation. I think what I'm waiting for in the immediate short term is to see what announcements we see under the PLI scheme from global companies or even Indian companies respect. Some of the areas specifically we don't have technology. I mean, in other areas I don't see too much of a problem about Indian companies. Let's say if it comes to automobile components or pharmaceutical drugs or textile, steel, which are also part of PLI, and I think there are enough number of Indian companies who can do all those things. But the real big ones will be if we can see something on the electronic side, on batteries. That would be the real win for India. We can attract some big overseas companies to come and invest.
All right, Sanjeev, wonderful to have you, and wish you a wonderful year ahead, and have a great day ahead.